This week on Sylvia's Traders Lounge.
A market maker is someone who, when you go and pull up a quote, you see the bid and the ask spread. So let's say a stock is trading $50. A market maker will decide, well, I'll buy it for $49 and I'll sell it for 51. They're making a spread, so you can come in and decide what you want to do with that stock. So you have to find the price.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. And our guest, as said before, is Ryan Sellers. The theme and topic for today's market insights into reactive trading for day traders with Ryan Sellers. Ryan Sellers began trading in 2002 at the floor of the Chicago Board of Options Exchange, that is CBOE, as a market maker in the DJX and SPX pits. In 2005, he joined the proprietary trading firm, Trebuchet Financial, where he continued to trade options and equities. After 13 years with the firm, he left the firm in 2018 to trade for himself. He is currently an active day trader using news and options volume to identify trading opportunities. In 2014, Ryan began using the OpenOutcrier Twitter handle to post real-time stock and options trading headlines, breaking news, rumors, and strategy. In early 2017, OpenOutcrier.com was launched as an extension of the Twitter handle and integrated news platform. The site consists of the OOC feed, a custom BenzingaPro newswire, chatroom curated social media feed, and searchable archive. So welcome, it's an honor to have you.
Thank you so much for having me. It's a pleasure to speak with you guys.
Yeah, and maybe you can just start off by giving us a brief history. I know I have read out your bio, but from your experience starting out at the floor of the CBOE and also now becoming an independent trader, how that transition has been for you.
Sure. So I began right out of college in 2002 as a market maker on the floor of the Chicago Board of Options Exchange. And that's the things that you see in the movies where everyone's on the floor in a pit together, yelling and screaming as orders come into the pit, and you're kind of, it's a rowdy place where you're trying to make markets for the orders. A customer would come in and ask what you could buy or sell a certain option for, and then we would tell them what the prices are, and then the best price gets the trade. So it was a very competitive, very interesting way to learn the markets. I learned quite a bit about volatility and options that way. I had a very, very good teacher from the company I worked at. And unfortunately, though, the timing was, that was a sort of the floors were a dying breed. They went away after a period of time because the technology advanced where they were no longer necessary. So a lot of trading kind of was migrating to electronic trading at the time. And the floor trading was going away. So I was traded on the floor for 3 years until that company decided that they no longer wanted to make markets on the floor. They didn't need market makers. They could do it electronically. And so then I moved to a proprietary trading firm. And that's a firm where you trade the capital's money and the firm's strategy for itself. You don't have customers, you don't have clients. You are trading your own ideas with the company's capital. I was there for a long time, 13 years. We did a few different strategies over that period of time as I learned to trade and kind of honed my own strategy and style of trading. We began trading as market makers where we would respond to the markets by placing lots of quotes out there and getting filled and scalping trades. And in 2008, when the financial meltdown happened in the United States with the mortgage crisis, we got run over, and it was the worst year of trading I ever had. We had a very, very difficult year. We were sitting on markets, sitting on bids and asks, trying to make markets and trades, and we were getting run over by the volume and the flow as the markets were moving extremely fast. And during that period of time, we realized, well, maybe we don't want to be the ones sitting on the bids and asks waiting for trades. We want to be the people going out and finding trades for ourselves. And we want to be the people who are doing the running over, not the people getting run over. So from that period of time, we completely revamped our strategy, and our strategy went from market makers to market takers. And now I'm employing that same sort of strategy today, where instead of looking and sitting and waiting on markets, and I'm constantly actively looking for news and volume and things that are going to move so I can catch a big move in a stock versus sitting and waiting and just scalping a little bit of money in between, waiting for something big to happen. Now I feel like I'm more, I'm on the hunt for the big move, and I'm looking for the big move. And then when I see what I like, then I hit it aggressively versus just kind of taking little pieces of the market all day. And that's what I'm still doing today. As of 3 years ago, the proprietary trading firm went apart. And I've been trading for myself for the last 3 years. I've been working from home now, and I don't know, it suits me. I like being my own boss. I like the hours. I still love the markets, and I don't know, I love it.
All right, and maybe you'll tell us the difference between a market maker and a market taker, but just to build on to that conversation, why would you say now, as an independent trader working from home, why reactive day trading is suitable for those people who want to trade in equities, stock? Yeah.
Sure. So we'll start with a market maker versus a market taker. A market maker is someone who, when you go and pull up a quote, you see the bid and the ask spread. So let's say a stock is trading $50. A market maker will decide, well, I'll buy it for $49 and I'll sell it for $51. They're making a spread, so you can come in and decide what you want to do with that stock. So you have to find the price. I trade specifically options. So in options, it's the same thing. If you want to come in and buy a call and the call might be worth 50 cents, well, then the market maker will say, I'll buy it for 45 cents and I'll sell it for 55 cents. So that's making a market. That's creating the bid and ask spread so that other retail investors and people can come in and they can trade and create the trade. The market maker is saying, well, I'll take a nickel of profit on either side to buy or sell whatever you want. And that's how they make their money. The market maker is providing the bid and ask spread. As a market taker, I'm no longer quoting a bid and ask spread. I'm going and finding something that I believe is mispriced. I believe that a call option is cheap because maybe a good piece of news hit the market and now the stock is going to go higher, so the calls are going to go higher. So I am paying the ask on the spread. I'll pay so I can get long a call so that the market will move in my favor. So I'm going and finding opportunities where I think the market's going to move. And that's my strategy now. As I would say that I am an active day trader. So I am looking for very quick moves, and I'm looking for news and volume that's going to tell me where those moves might come from. So I'm very active into news. I'm very aware of all the news that happens in the market. I do lots of pre-market prep so that I know everything that's already happened, so that when something new happens or there's a change in a news story, I can react to it properly.
Good. Hello, Ryan.
Hello.
Gilbert here. A few questions. What do you think is the ideal capital size for you to start in trading equities? Because we tend to get different quotes, like from people, especially if you're trading with US brokers. So what do you think is ideal in US, and if you're also looking to use offshore brokers, what are the ideal amounts?
Right. So there's an interesting rule in the US markets. It's called the pattern day trader rule. And this is a rule that is designed, the idea behind it is it is supposed to protect the individual investor from over trading or from doing things that they're maybe not prepared to do. And I believe that the numbers on this rule is, in a 5-day business day period, you can only make 4 trades while using margin. So that is the stipulation that the government says when you're using a broker based in the United States. The minimum, the number that they use to determine whether you fall in this rule is $25,000. If you have a $25,000 account or less, then you can fall within what they call the pattern day trader rule. And this limits your trading. Otherwise, they will take away your margin if you break this rule. So if you are an active trader and an active day trader like me, 4 trades in 5 days is nowhere near enough. So you need a $25,000 account minimum. And that is the low bar. So that means if you go in on day one and $25,000 and you lose $1, you are technically below that rule, and they will call in this rule on you, and they will limit your account. So you want to give yourself a buffer period. And I would say probably $40,000 to $50,000 is what I would recommend for the minimum account. So you have some wiggle room. So you're not stressing out about, oh, I lost $1. Now I fell back below this rule. So in my opinion, if you're going to be an active day trader, then you want to start with probably $40,000 or $50,000 in an account. Now, you don't have to have this amount of money to be a more, let's call it a more casual investor or a swing trader. You can work within this pattern day trader rule on a smaller account, but you just need to approach it in a different manner. You need to approach your trading in a medium to longer term manner where you're doing swing trades or investing, and then your account won't have any of these problems with the pattern day trader rule.
And what about offshore? If you're going to use some of the brokers who are offshore, but still give you access to US equities?
Correct. They have different rules and stipulations that I'm not familiar with, and I believe it would vary depending on the locality that you chose. So you could use a broker from the UK, or you could find a broker from Africa. You could find brokers all over the world, basically. But you're going to have to really check out their individual rules to determine whether it suits your style of trading and your activity. And also the capital requirements are probably going to be quite different as well.
Yeah, I think people who have invested in shares and equities with scope markets can attest to what Ryan is saying. It is capital intensive, right?
Yes.
Yeah.
And does the same apply to stock options if you're going to be trading options?
Yes, the same rules apply to stock options as far as pattern day trading and account requirements. Some places actually require a little bit more equity in your account if you're trading options, because when you trade options, there's leverage involved. That means that you get more exposure to the market with different capital requirements. Each one share of an options contract represents 100 shares of a stock. So that's where leverage comes in, and that's what that means. If I buy 10 calls in an underlying stock, I'm actually representing 1,000 shares of that stock. The way that I trade, I trade almost exclusively options because of this advantage of leverage that I get. I can use less capital to gain more exposure in the markets. But the one way that I trade is I only get long. I only buy calls or puts. I never short them, because theoretically, if I'm wrong on a short call, then I am at risk of that leverage. It can go against me much faster. If I short a call and it goes against me, then I have theoretically an infinite amount of losses. But if I buy an option, the only thing I can lose is what I pay for it. So that's one of the ways that I manage my risk.
Sorry for that. And what about, could that be the reason why we were seeing people's short, when it came to the GameStop stock?
Yes. Yeah.
With the hedge funds that were short selling, the reason why they had to cover their positions was because of that kind of an exposure. They have unlimited exposure when you're short selling, but if you're going long, then it's limited.
Exactly. So that's the risk of short selling a stock or short selling an option, is you open yourself up to an extreme amount of risk when it goes against you. And that is the nature of a short squeeze. Is you find someone or a group of people who have the stock going against them. So if you're short a stock and the stock starts to move higher, they reach a point where they need to cover their position. So then that's when a short squeeze happens, is you have buyers coming into the market. The shorts become buyers because they need to cover their position. So you basically have two groups of people who are all doing the same thing, and they all have to buy it for different reasons. A similar thing can happen when we're talking about using options and how options will affect a stock. So you might have heard the term a gamma squeeze. And this is something that happens in the options markets when if a group of people go and buy an out of the money call, then there's something that a market maker should do is they should hedge their position. So if the retail traders are buying calls, the market maker is then selling them. Well, the market maker, in order to make their little bit of money on the bid-ask spread, hedges their position by trading the stock. So if a retail trader comes in and buys stock, the market maker, buys the option, the market maker is selling the option, but in turn, in order to hedge their position, they go in and they buy the stock. So if you see a lot of lopsided buying in options, it could be calls or puts, but we've seen it mostly in calls. And so they come in and they buy a whole bunch of calls. The market maker has to buy their stock in. Then let's say the stock starts to go higher and higher. Well, the closer that the stock gets to the options position, the more stock that the market maker actually needs to buy to hedge his position, because it becomes a greater and greater chance that that option goes in the money. And so you see these are more, it's like more fuel to the fire. And then GameStop is the perfect example where you have an overly shorted stock that shouldn't have been as short as it was. Then you get people that start to buy the options. And then now you just added a third group in there that is market makers that need to cover their position. So you have retail traders buying the stock. You have the shorts that need to cover their position. And now you have market makers that need to cover their options exposure. And it was gasoline upon kerosene on a huge fire that made it just go insane.
All right, thank you for that explanation. What about the importance of being updated on current market news, such as what's being offered with Custom BenzingaPro and Newswire? Why is that relevant to equities traders, constantly being updated by what's going on or with the news?
Yeah. So for my style of trading, news is almost everything. I need to be aware of, I'm an active day trader. So every day I'm looking for a new opportunity or opportunities to take advantage of. So I need to be aware of everything that's happened. So when something new does happen that changes the narrative on a stock, I can act. So for me, it's very important. I think the way to approach, some of the best ways to approach markets are, you can think of it two ways. You can think very fast or you can think very slow. And for me, I think very fast. I'm very active. I'm looking for it and I'm on top of it. The other reason you want to be aware of markets is as a longer term investor, so you can think very slow about things. You can manage trends, and you can see maybe when a narrative has changed in a stock, so that there's a change in the trend of a stock. So you can find new opportunities and also determine when to exit a stock in a longer term position.
All right. Ryan, you can take us through your daily trading activity using like an example of how you day trade equities. And this is now the time for your presentation. You can share your screen and take us through that.
Can you guys see my screen?
Yeah.
Okay. So this screen on the right here, this is the trading platform where from OpenOutcrier, where we post news and information for other traders. We have a small trading group and a group of members, and we're constantly sharing news and ideas. So this was an example that I had from yesterday, and the stock was Penn National Gaming. They are an online sports betting site in the United States. And at 12:45, this window here, this piece of news came out that affected what I believed was two of the major online sports betting stocks in Penn and DraftKings. And it was that legal single sports betting in Canada was going to be starting at the end of the month. So in my opinion, this is good news about a new potential market for the online sports betting stocks. Here's a chart of Penn Gaming right here. And as you can see on the chart, right when the news came out, we immediately saw a stock reaction. You can see the stock start to go up, and with it, the two things I want to see is I want to see stock movement and I want to see volume. So this is the volume on the bottom and this is the stock reaction on the top. So the stock moves green on a nice green candle with notably higher volume. That's exactly what I'm looking for. My reaction was I immediately went to, I I immediately went to the options market and I bought calls. I believe the stock was going to go higher. So I went and bought calls, and these are the times and sales of the trades that I actually made. So the stock was trading 71.5 at the time, and it might be a little bit hard to see, but I bought these 73 calls about 100 times for 80 cents. This is just out of the money calls or puts is what I like to trade because they're going to have the greatest rate of change on a violent move in the stock. I was in the trade. I started selling it about 45 seconds later. I bought the calls for 80 cents and I started selling the options for $1. This is about right here when the stock started to not move higher. When the stock started to not move higher, I'm immediately selling my position, and within 45 seconds, I started to sell it, and within 2 minutes, I was out of the trade. I only made 20 cents, but I was able to take 20 cents in an options contract 100 times, and that was a quick $2,000. So this is the setup that I'm looking for. It's new information that happens in the market where I can see a stock reaction with volume. And then I'm using options to capitalize on that move. And I'm in these trades pretty fast, from anywhere from a handful of seconds to only a few minutes. When I believe the stock move is done, or I see the options start to trade the other way against me, then that's the moment when I start to sell my position and look to get out of the trade. And I get into the position aggressively at once. That's why I bought the trade right at the top one time. But then I'm scaling out of my trade depending on what the market does. I want to give it a chance to go higher, but also if it's not going to move higher for me, I want to make sure that I lock in some profits on the way. So yeah, that was the best example I had of yesterday of a quick hitting market trade and the way I like to approach things. If there was bad news, then I'd look to buy puts, because puts increase in value when the stock goes lower. But in the market we have right now, where it just seems like everything goes higher all the time, it seems like I'm trading calls quite a bit more than puts these days.
And do you normally get in pre-market, or you wait for the markets to open and then that's the time you make your positions?
I do the majority of my trading during market hours, but that's also because I trade almost exclusively options, and the options market does not trade outside of normal market hours. So the options market is only open from, what is 8:30 my time? Obviously, it's quite different for you guys. But it's only open between market hours, which is 8:30 to 3 in my time zone. And then if I do trade outside of market hours, then I will trade stock. So as I'm preparing in the morning and watching news come out and getting my day ready, if there's some breaking news in the morning, then I will trade stock for that move.
Can you show us an example like of a stocks trade?
Of a stocks trade?
Yeah.
Well, the example would be, it would be pretty similar. It would have a similar sort of chart. It would be, but instead of using the options, I would probably go and I would buy, for me, anywhere between 1,000 and maybe 4,000 shares would be my max, depending on the size of the stock and the move that I expected. Being very in tune with the news, I'm looking for the things I would look for in the pre-markets would be something that a sort of narrative that is working at the time. In the last year, it might have been a drug company with some sort of COVID stock news, a company that was making a breakthrough in the vaccine, or a company that made a breakthrough in COVID testing, is something like that. So I like to look for narratives that make sense to me, that are logical, and then find the breaking news that fits that narrative for me. You can see the sort of flash in the pan news stories, the things that sort of get hot for a while and then go away. Last year, it was COVID. The year before, and even coming back this year, it was crypto quite a bit. If a company is doing something in the Bitcoin space or in with crypto or blockchain, that usually gets a little bit of interest. There was a moment in time where it was NFTs. Any company that was getting busy with non-fungible tokens was a big deal. So for me, being aware of these narratives and then being able to act on breaking news within that narrative.
All right, thank you. So I'd like to open up the floor to anyone who has any questions. Any questions that you'd like to ask Mr. Ryan? Feel free to post them in the Q&A section or even in the chat area. And for Ryan, maybe, do you have any other example? Maybe you can give us like how you'd consume the information coming in from the news, from the, what do you call it, the newswire or the sources of your news, and how you'd be able to interpret that as either being something positive for the stock, and then, you know, like your reasoning before you make the play, like
Sure.
do you get information before, then put that onto some kind of, what would you call it, like a watch list?
Yep, sure.
The one that you decide to take a trade on.
Yes. So I'm extremely active with news, and that means that I need to monitor multiple news services. I watch a lot of different professional feeds, from Benzinga to Fly on the Wall to Street Insider to Bloomberg. I look at lots of different feeds. And that's because different news feeds tend to get different information first, and you never know where you're going to see it. And for me, it's all about getting it as fast as possible. I believe that one of the greatest sources of information out there is really just a well-curated Twitter feed. If you can put a really good Twitter feed together on TweetDeck, you can find amazing information for free. And it might not be first, but you can get reasonably close for what is free, essentially. So if you can do the time and put the work in on a well-curated Twitter feed, it's well worth it. I do. So each morning I come in about 2.5 hours before the market opens, and I start my process of what is moving and why. That's what the questions I ask myself. What's moving in the pre-market and why, or what might move on something that's happening right now. So I start to look at, and I go from the big picture. I start with macro information. What's happening in governments? Are there anything big there that might change things? And then I grind down to the specific news stories of the day. From there, I'll create a watch list of a handful of stocks that I think could continue their moves, or also stocks that might have news that is possibly imminent, possibly something that's coming out soon. That's worth keeping an eye on. I don't like to put trades on trying to predict things. I prefer to wait for the news and be reactive. But from that watch list, what I'll do is I'll really stalk a trade if I think something is going to happen. So an example of that is the best trade I ever had was a few months ago, and it was on a stock called Workhorse Group. They're an electric vehicle company that was pushing for a US Postal Service contract that was going to be, if they got it, an enormous contract for them. And they're a small, newish electric vehicle manufacturing company where they manufacture basically delivery vehicles. So everyone knew that they were pushing for this US Postal Service contract. And then the news came out that the Postal Service gave the contract to someone else. They gave it to Oshkosh. As soon as that happened, I was ready in my head for this news to happen, so I knew what I wanted to do. So I immediately went to Workhorse stock, and I bought a whole bunch of puts. I bought a lot of puts in the stock because it was very material for this company. They don't have a lot of business already, and this would have been a huge contract for them. So since they are now confirming that they are not going to get this contract, it was a very bad news story for them. So that's where I don't like to think of it as predicting, but I like to think of it more as game planning, where you prepare yourself for a situation and then you're ready to react to it. So you're not kind of fumbling around once the news comes out. Another story, similar story like this would be right now, I'm kind of looking at Boeing. Boeing is very interesting to me because they're still having some trouble with the approvals of the 737 MAX. And every time it seems like they get out of the gates, they have another issue where they're going and testing the planes again. And right now they're trying to get approval of the Boeing Max in China, which the Chinese market would be huge for them if they can get it reopened up and start to get orders on planes. So I'm really watching Boeing to see if they can get the Chinese approval, and that would clear a major hurdle for them, in my opinion. Conversely, I can talk about the worst trade I ever made, which was just a couple weeks ago. And that's a situation where instead of being prepared and waiting for news, I just saw I was just trading Tesla, and I saw a stock that was making new highs that I thought was going to go higher just because I thought it was going to happen. I had no reason to take the trade. There was no news. There was nothing. I just thought this stock is going to go higher today. And so I bought a bunch of calls and it didn't work out. But as soon as I get out of my comfort zone in my lane and where my knowledge is, which is reacting to news and trading off of that, I get myself into trouble. You know, you don't manage your risk properly. You make one mistake, and then from there it was almost a waterfall of little mistakes after that. So staying focused and sticking to your plan so that you don't get yourself out of your own zone is very important, and it always will be if you're an active trader.
Yeah, and please talk to us more about that aspect of risk management, because I think that's where most traders fall short of, and then they end up blowing up their accounts.
Yes, absolutely. So it's interesting to me to think about it, think about trading like this, because it's not the best traders that I know are not the smartest people that I know, because you don't need to be the smartest, most intelligent, max genius IQ type of person to be successful in trading. What you really need to be is you need to be very disciplined. You need to be very much in control of your emotions and in control of your risk management, because anybody can go in and take money and put a trade on. But what you do after you put the trade on or the investment is paramount to if you're going to have long-term success. If it goes against you, you need to walk away. You need to manage your risk in every situation. And the people that can't manage their risk, you're going to blow up. The statistic is supposedly that 9 out of every 10 traders or something like that fail. 9 out of 10 people who attempt to trade actively as a trader end up failing in some capacity or blowing up their account at some point. And I've had very bad days, but I've never blown up an account. And it's taken me a while to get to the point where I've had some of the really good days, but my approach was always, I want to do this for a living. I don't want to have a couple good years and then talk about how fun it was. No, this is a career for me. So for me, I've always wanted to make the money, but also I've always wanted to make sure that I protected my capital at every turn. And that's one of the reasons why I talked about only buying options on the long side. That's a way for me to manage my risk. Every trade I'm in, I know what I can lose. I cannot lose more than I put on the table, as opposed to trading with margin or trading on the short side and these other things that can get you in a bit of trouble if things go against you.
All right. So like from what I'm hearing is that you use options as your hedging mechanism when you're trading stocks.
It's not a hedge because I don't have a position against it. I'm only trading the option. I'm not trading the option versus a stock position, which a lot of people use options for is a way to manage the risk versus stock position. Me, I'm using it as a speculation vehicle. And if I think something's good, I will buy a call. If I think something's bad, I will buy a put. And it's pretty much just that straightforward. As soon as I see something that I think is good news that's going to move a stock, I will go and buy a call. My conviction will determine my size in that position. Sometimes I might buy only 10 or 20 options. Sometimes I might buy as much as 500, depending on the cost of the option and how I feel about it. It varies very wildly.
All right. And would you say your conviction has come from your years of trading experience from the floor to becoming an independent trader? Because with traders, then they might want to ask themselves, do I act based on a feeling or do I act based on what I believe? And there's like a gray area on that.
Sure.
And that-
Yes. Yes, definitely. So my conviction comes from two things. It comes from experience and it comes from confidence. And the way that you get experience is by doing it, obviously. I mean, you need to put the time in order to feel good about what you're doing. And that's why you should start small. You shouldn't come out of the gates trading 1,000 shares of a stock or whatever. You need to start with a reasonable number so you can make the mistakes when they're not going to hurt you. Everyone's going to make the mistakes and you got to learn. You know, they call that the cost of tuition. Losing trades is your tuition in the marketplace. You got to learn from them so that you can grow from them. And there's going to be growing pains like anything else, but you want those mistakes to happen in a small size so that later on when you're trading the big size with confidence because you've learned, then you don't make those same sort of mistakes.
All right. So is there anyone who has a question for Mr. Ryan? Please type it in the Q&A area or the chat area. I could see Wesley was raising up his hand. So I'd requested Wesley, if you could type in your question because we're not going to unmute you. So kindly just type in your question and Ryan will be able to answer it for you. All right. Do you normally trade small cap stocks, mid cap stocks, or large cap stocks? Like what kind of stocks do you mostly trade? Like range.
I'll trade almost anything, depending on how confident I am with the news story and how I feel my reaction time to that story is. That I don't have the opportunity because I like to trade options. Some of these smaller stocks don't have options listed on them. There isn't the interest for the markets to make it worthwhile for them to list options. So I'll typically steer away from them unless I really like the story or the information, in which case I'll go back to trading stock on that particular equity or underlying. But I typically stick to the mid to larger cap names where I feel more comfortable with the information and the news coming out from them. There tends to be a little bit more uncertainty in the smaller caps. Now they can move quite a bit, but a lot of those moves tend to be spikes and fades because people overreact to them. A lot of times you see a lot of people rush into this news story. And then as people try to figure it out, they tend to come back to earth a little bit on these names. So you need to be careful in trading some of the smaller cap names and know that there can be a little bit of there can be a lot more volatility in some of these.
Something I've noticed about American traders is most of you guys are into equities and very little of Forex.
Yep.
What's your thought on that? Why is it that? Is it the regulations in US to do with leverage and the FIFO rules and all the other rules that came into place? Or is it just a preference that there's more volatility in the stock market than there is in the Forex market?
I think it's easier to access equities in the United States markets when you're in the United States. Obviously, I think it's easier to access Forex sometimes when you're outside of the United States. So it seems that becomes a starting place for a lot of traders that are not based in the United States to me, is the Forex markets. I never traded it personally, but my tangential experience with people who have traded Forex in the United States is the companies that seem to sell this sort of trading platform or strategy, they seem to be a little bit on the shady side to me. They seem to want people to trade. They want you to trade a lot and they don't care about if you make money or not. They just seem to be looking for their commissions. And they do a lot of churn, which means they bring a lot of new people in and a lot of people fail. And then they bring new people in and they fail. And that seems to be their business model, in my opinion. And it seems a little bit unsavory. Hopefully your experience has been different. I don't know, but that's been my little bit of experience with Forex in the United States.
Okay, thank you for your honest opinion.
Would you say that's really unprofessional? And
Yeah, it's unprofessional. So that's if you're looking at a company to help you trade, a brokerage firm or a clearing firm, then you need to do a little bit of due diligence to try to figure out which of these companies are trustworthy, which of these companies are actually going to support you and teach you and maybe give you the opportunities to succeed, and which of them are just there to let you trade and not care about what happens to you and just try to get you to be active for their own benefit. So do a little bit of research there, because unfortunately there's some bad actors out there who do some things that are pretty unsavory.
Yeah, and as we wait for the questions, like, what would you say are some of the common red flags for such kind of brokerage firms that obviously are out there to just make a commission from traders and that's it?
Look at the fee structure, see what they're charging, how they're charging it. Be aware of that. Try to do some comparisons. Try to look at as many brokerage firms as you can and clearing firms as you can, so you can compare their fees apples to apples, side by side. What am I getting charged for and why? Look at education. A good firm will offer education and support through either mentorship or tutorials or classes or something like that along those lines. And then also look for churn. Look for how often they turn over accounts, how many people they have under their umbrella, and try to ask those questions. I think that's a good starting place.
Thank you. Thank you. Are there any other questions? Is there anyone who has a question before we wind up our session? Let me just give people 1 minute to type in any questions that they have.
Yeah, and I think it's also important to mention that Scope Markets actually does offer free educational webinars Monday to Friday on the Scope Hub channel, as Ryan is talking about. And Ryan, what would you advise traders, like which book comes to the top of your mind when it comes to reactive day trading for both seasoned and novice day traders?
One of my favorite authors on the subject his name is Mike Bellafiore. He does 2 books. One is called The Playbook, and oh man, and I can't recall his other book right now, but he has 2 books out there, and they when I read them, they really spoke to my experience with what the day trading world was like and how to handle it. And he does quite a bit into technical analysis as well, and talking about preparing your own parameters to set up your own playbook, which is what makes sense to you, what sort of trades make sense to you, so you can repeat them over and over again. Doing the work and doing the homework. And I think personally, one of the best ways to become a good trader, if you're an active trader, it's about the work you do outside of the markets. So when you're sitting at your chair during trading hours, it's easy to click the buttons and a point, and, and look at things, but you don't learn from what you did that day unless you do a trade review after the markets. You kind of go over what you did. You see, what did you do right? What did you do wrong? How can you repeat it in the future? And how can you avoid the mistakes you made that day? So doing an honest trade review of yourself is one of the most helpful things that I've found for my own trading.
All right, and guys, if you wish to reach out to Ryan, his website is http://OpenOutcrier.com. And he's also very active on Twitter at OpenOutcrier. That's his Twitter handle. And also check out the link to his website from BenzingaPro. I think that's a very good and trusted fundamental resource item for your news trading.
Yes, so that marks the end of the Q&A section. I can see there were no questions. So if you do want to reach out to Ryan, like Sylvia has said, you can go to his website, OpenOutcrier.com, and also his, is this for which social media? Is it Twitter or?
Mostly Twitter, yes.
Yes, at OpenOutcrier.
Yeah.
Yes.
Any final remarks, Ryan? I know it's been it has been quite a short session to just talk about everything that you've been doing for the last almost 2 decades, but maybe your last parting shots. And of course, we'd love to have you again on the Trading Lounge in the future. So
yeah, I'd be honored to come back. Thank you so much for having me on and chatting with me. Yeah, I think I could possibly come up with some more in-depth examples to walk people through the thought process or the process of how I approach trading. But in more, that would be for probably a little bit longer than a closing statement. But in the meantime, it's for me, I love trading. I love doing it, but I come to the markets every day excited to find that next new thing. But if you don't manage your risk, you're not going to have that opportunity in the next day. So be excited, and it's okay to make mistakes. It's okay to fail, but just make sure that the mistakes are reasonable for your account and what you're doing, so that you can come back and have the opportunity to trade the next day.
all right. So I think that marks the end of this webinar session. Thank you so much, Ryan. And guys, we continue to ask you to open live trading accounts with Scope Markets to apply the lessons we've learned from today's webinar. And Ryan will link down the links to your website and your Twitter handle on our YouTube channel as we upload this recording for next week, and then share it with you as well.
Thank you very much. There might be a couple of videos on YouTube also if you want to see more about my style of trading. Check out either OpenOutcrier or Ryan Sellers, and I believe a couple will pop up if you guys are interested.
All right. Yeah, I think we'll link those down on the show notes as well. Thank you so much.
Thank you very much, guys.
Have a
Thank
good
you,
day.
Ryan.
Thanks.
All right.
Bye-bye.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar.
Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading.
Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.